Hello, we're going to work on Chapter 8 today. Chapter 8 has to do with receivables. You know, in previous chapters we've been going through and just writing down accounts receivable or maybe even notes receivables, and we're just assuming that everybody pays us what they owe us. Unfortunately, in the real world, that's not the way it works. We're going to have some deadbeats who are not going to pay us. And so we're going to have to work in this chapter with learning how do we record that. Now, we have two receivables that we're going to be looking at or dealing with. The first one, accounts receivable, we've been dealing with that for all of the previous chapters. That's when somebody owes us money, they've charged it. It's usually a very short-term time frame for those folks. They usually have about 30 days to pay us what they owe us. When we're dealing with notes receivables, especially in this chapter, we're going to see that if people had accounts receivable, if they owed us money and they have not paid us within that short time frame of probably about 30 days, then we're going to convert that accounts receivable into a note receivable. So we're just going to take it out of accounts receivable by crediting it, and we would debit notes receivable. And so what happens, the difference between the accounts receivable and a notes receivable is that notes receivable, the person who owes us some money is going to pay interest. In the second lecture that I'll be making today and everything, we're going to learn how to calculate how much they owe us and the due date. But for this first part, what we're going to do is we're just going to talk about the fact that we have an adjusting entry that we make. Let's see, let's go over to page 495. And what's going to happen is I'm simply showing you on page 495 that there are two methods of, let's see, it says, how are uncollectibles accounted for when using the direct method? Well, here's the deal. There are two methods for determining our uncollectibles. The first one is the direct write-off method. We are not going to use that method. In my book, I have a line drawn through from this part over to the next page on 496. This is something for smaller companies that do not have to report using GAAP, Generally Accepted Accounting Principles. And so direct write-off method, we will not be using this method, and so you do not have to read about it. You don't have to learn how to do that. We're going to be using the method that's called the allowance method. This starts on page 497. This method requires us to match the expense of bad debts with the time frame of the money that we earn. So basically what happens is we know that there are going to be people who are going to owe us money, and we have to estimate how much of that money are we not going to receive. In other words, people are not going to pay us what they owe us when they owe us. And so we go through, and there's using the allowance method, our book tells us there are three ways that we calculate how much people will not pay us. And so once we have calculated the amount, then we record it in this adjusting journal entry. Bad debt expense is debited. Allowance for bad debts is going to be credited. It's not going to matter which method we use with the allowance method. Of the three, we're going to make this journal entry every month to show how much we do not feel like we're going to receive. Now, also over on page 498, the next page at the bottom, you'll notice that there is a journal entry. Well, it starts out by telling us writing off uncollectible accounts using the allowance method. And so we're going to go then to the next page on 499, and here, if we write off somebody after a period of time, if it is determined that this person or this company is not going to pay us, then we do what we call writing them off. When you do that, you're going to debit the allowance for bad debts and you're going to credit accounts receivable. the expense that we made, the bad debt expense, was made previously, and that expense has already been posted and used with our income statement. Allowance for bad debts, this was originally the credit in that adjusting journal entry. This is a contra account to accounts receivables. And so when someone says that they're not going to pay us, or else if they have just ignored us for several months and all, we learn that we're going to write it off. And so this is the journal entry to write it off. Debit allowance for bad debts, credit accounts receivables. You know, I'm going to go back to the previous page because I realize I did not emphasize enough about the fact, well, where is it? It's on page 497. Let me go back to page 497. I did not emphasize enough to you how this works. The allowance for bad debt is a contra account to accounts receivables. And so if right now, looking at these two T accounts on the bottom of page 497, if you were asked what is the net accounts receivable, what that means is you're going to subtract this allowance credit from this accounts receivable debit balance. And so your net accounts receivable would be $4,320, the difference between the two. And I want you to understand that. That's very important because you're going to have questions that say, what's your net accounts receivable? And it is the accounts receivable balance minus the balance for the allowance for bad debts. And so that's why I went back to try and capture that. Okay, so we looked over on page 499 when we write off an uncollectible. And then I'd also like for us to show, and this is on the page of 499, it starts at the bottom of 499. Let me get to that page. On the bottom of that page it says recovery of accounts previously written off. What happens is if we write somebody off and we turn them into a collection agency, this hurts the credit rating. And so whether it's because they're trying to work on their credit rating, or perhaps they're just trying to be honest and pay us what they owe us, if some company comes back and says, hey, I want to pay you what I previously owed you, what I want you to remember is that we have already written them off. Their accounts receivable balance is no longer in our books. We don't show them anywhere. So we have to make two journal entries. The first journal entry is we're going to reinstate them saying, okay, accounts receivable for Callahan, allowance for bad debts, because we're putting them back into that allowance category. This is where we keep the amount that we think we're not going to collect. So anyway, we're putting that back in. And then the second journal entry is to show, hey, we have received cash from Callahan. So we're going to debit cash, credit accounts receivable. And if you're thinking this is so confusing, why do I debit accounts receivables here, credit accounts receivable here? What I want you to remember is we had already written them off over on page, let's see, where is that? Over on page 499. We wrote Callahan off, so they're no longer in our book. So the purpose of this first journal entry is we put Callahan back in, and then the purpose of the second one is now that they're back in, we're going to show that they've paid, and we're going to credit that amount. So well, I think I'll end at that point, and then we'll come back in and talk about the different allowance methods after this journaling, after this taping segment.